Hi, everybody, and welcome back to video number 3 in Chapter 6. When we've left off, we were going to look at explaining accounting issues related to the valuation of accounts receivable. So here, when we value accounts receivable, we're going to record credit losses as debits to bad debts expense. It's a normal and necessary risk of doing business on credit. Eventually, you're going to have some customers that don't pay you. There are two methods to account for uncollectible accounts. One is the direct write-off method, and the other is the allowance method. As you'll remember, direct write-off method is not permitted under GAAP. The allowance method is the one that is permitted under GAAP. So let's look at that. The direct write-off method is theoretically deficient because we're not matching our write-off with our revenues. So the revenue is not stated, or receivables are not stated at the cash realizable value. And it's not GAAP when material in amount. It's not GAAP when material in amount. Okay. Now, occasionally, it happened to me, we'll have our customers will be nothing but blue chip companies, meaning that their credit worthiness is unquestionable. And you can look at what we expect to receive from those customers, and your allowance may be zero as a result, but you still analyzed it and determined that you can collect all of the receivables that you have. But the allowance method under normal circumstances is used. We estimate those losses. Estimate those losses. We can do that in two different ways. We can use percentages of sales and percentages of receivables. And GAAP requires that when it's material in amount. So when we're using the percent of sales method, you'll remember that we do not consider the allowance for doubtful account balance in computing that allowance, whereas with the receivables methods, there are two of them, we do. Okay, let's take a look. The direct write-off method. When a company determines a particular account to be uncollectible, it charges the loss to bad debt expense. So let's assume that on December 10th, Cruz writes off an uncollectible USADO's $8,000 balance. The entry, pretty much as you would expect, we're going to debit bad debts expense and credit the accounts receivable USUDO, their subsidiary accounts receivable account, which will be $8,000 in this case. Now, the allowance method involves estimating uncollectible accounts at the end of each period, or periods as the case may be, that ensures that the company's state receivables on the balance sheet at their net realizable value. Key terminology here, net realizable value. Companies estimate uncollectible accounts and net realizable value using past and current events, as well as forecasts of future collectability. Okay, let's look at how we do that. Here, the Brown Furniture in 2025, its first year of operations, has credit sales of $1.8 million. At December 31st, the company reported accounts receivable of $150,000 from those sales. The credit manager estimates that $10,000 of those sales will be uncollectible. The adjusting entry to record the estimated uncollectibles, assuming a zero balance in the allowance account, is going to be a debit to bad debts expense and a credit to the allowance. You will notice that bad debt expense is going to hit the income statement right there and there, right there and there. And we will set up this allowance as a contra asset account on the balance sheet. Now, you will know that we haven't had any real bad debts expense at this point in time. This is an estimate, okay? So now, Brown reports bad debt expense, just like I just said. Here's the contra asset account, 10,000, and how it's reported on the balance sheet. The 140,000 is going to represent the net realizable value of those accounts receivable at the statement date. So now when you have a real live write-off and the companies have exhausted all means of trying to collect those past due accounts and collection appears to be impossible, the company should write that off. And the credit card industry, for example, it is standard practice to write off accounts that are 210 days past due. I think that's very, 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 very likely that it's going to be a write-off if it's 210 days past due. Okay, the financial vice president of Brown authorizes a write-off of $1,000 owed by Randall. So our entry is going to be, here we're going to see that we're going to reduce that allowance for doubtful accounts with the debit to the allowance for doubtful accounts. And that's going to represent a reduction of Randall's accounts receivable at that point in time. Okay. Now, here is how it would look in general ledger account format. Here is our accounts receivable. We're going to write this off and away we go. Now, I should point out that initially we had $150,000 of accounts receivable, and initially we forecast that 10,000 of it would be uncollectible. Therefore, our net realizable value was 140,000. But now when we write off 1,000 here and 1,000 there, you'll see that our new balance, 149,000 less that 9,000, is still 140,000. And that's what this slide reflects. So the write-off only affects balance sheet accounts. It does not affect the income statement accounts, a common student error. So don't let it be you. The write-off of the account reduces both accounts receivable and the allowance for doubtful accounts. The cash realizable value in the balance sheet therefore remains the same. In this case, 140,000. Okay, now every now and then we get a customer that makes good, and in this case, Randall's going to pay the $1,000 that was previously written off. So what we need to do is put that receivable back up, first of all. So we put the receivable back up here, $1,000, and we credit the allowance for doubtful accounts, just like we did when we wrote it off. Now, as we collect it, now we'll collect the cash just like normal and reduce accounts receivable just like normal for that $1,000 that we did collect. And that will restore the allowance for doubtful accounts back up to the $10,000. Okay. Note that the recovery of the bad debt, like the write-off of the bad debt, affects only balance sheet accounts. The net effect of the two entries above is a debit to cash and a credit to allowance for doubtful accounts, because these two receivables offset each other. Okay, the allowance method for uncollectibles, estimating the allowance. Here's a percentage of receivables approach. Now, whenever it's a receivables approach, we have two kinds of receivable approaches. One is a flat percentage of the receivables. And the more accurate method of doing it, the one that I always use, is an aging schedule. And you'll see that here in a second. But either one of these are a receivables method, and when we use either one of these, we need to consider the existing balance and the allowance for doubtful accounts. So let's look at that. An aging schedule also serves as a control device by which identifying which accounts require special attention and based on how long they have been past due. Any sophisticated company is going to have an aging schedule in one form or the other. I always looked at that as the first thing I did when I opened my computer in the morning. The aging schedule of Aloha Coffee Company is shown in the next slide, and it reports a balance of $26,610 in the allowance for doubtful accounts. There's no beginning balance in its allowance account, and the company's going to debit bad debt expense for this same amount. So here we are, and here's all their customers here, totals of 547,000. And then we age it under 30 days, 30 to 60 days, 60 to 90, 91 to 120, and then over 120. And this is over past due, assuming that it's 30 days to collect this, right? So normally under 30 days is not going to be delinquent. The remaining amounts are going to be in a delinquent status here. So what we're going to do here is how we're going to estimate this is we're going to take each one of these column totals here and multiply them by the estimated percentage we think is going to be uncollectible here. And multiply those through times each particular column. And that gets me to 26,610. And those estimates are based on historical loss rates, take into consideration whether it's reasonable, et cetera, et cetera. This is probably a little unrealistic in that 25% for over 120 days. It's probably more like 40%. And so what we want to do as practitioners, we want to make sure that my accounts receivable people are on top of those customers the very minute that that becomes due. Okay? We don't want these accounts to age. All right. So what entry are you going to make? Assuming the allowance had a zero balance, pretty easy. We're going to debit bad debt expense here for 26,610 and credit the allowance for doubtful accounts for 26,610. Now, what entry would you make if the allowance account had a credit balance of $800 before adjustment? In this case, when we have a credit balance, that means we haven't used up some of that allowance. So we can reduce the 610 by that $800, which we've done with this journal entry here. You can see the arithmetic, pretty easy to understand. Conversely, if we had a debit balance of 1,000, that means we drew our allowance for doubtful accounts by $1,000. So we have to add that $1,000 on top of the 26,610 to get to 27,610. Okay, that looks like a good place for us to stop this video. And when we come back, we'll take a look at putting this into practice a little bit with Rihanna.com. Until that time, bye for now.